Welcome to Crowded Market Report by Jason Shapiro. If you want more from Jason, subscribe to Crowded Market Report and get access to the CMR community, weekly reports, charts, and other exclusive content. Learn more at www.crowdedmarketreport.com or click on the link in the right corner.
Hello. Today is Saturday, October 21st, 2023, and I'm Jason Shapiro with Crowded Market Report, and it's Saturday night, so it's time to party. Let's talk about some really interesting stuff. I have gotten a lot of requests this week from people on our Discord about talking about hedging that I use in my portfolio from time to time, and I've been sort of much more actively hedging recently. And I put these trades, that I'm doing on our Discord in live time, and so a lot of people are like, "Well, what's making you do that?" Everyone sort of understands the process that I do for my main trades, using crowdedness, using market confirmation. I think that everyone sort of understands the risk management that I do in terms of sizing positions and how I handle my risk management. But this hedging thing is something that kind of gets a little confusing sometimes. So I'll talk a little bit about how I make those decisions, when I want to hedge, what I'm going to use to hedge, and how I'm going to size those hedges. And hopefully that will help. So first of all, when I want to hedge, I have always done something where once I have a bunch of trades on and I have a portfolio to look at, I'm looking obviously at the correlations between my positions. And that's because when you're measuring risk, let's say I get long, I'm risking 75 basis points per position. So just as an extreme case, let's say I get long the Dow, the S&P, the NASDAQ, and the Russell. Those are clearly going to be correlated trades over time. So if I think I'm risking 75 basis points in each one of those trades, then clearly my portfolio is risking a lot more than that, and it's essentially the same trade. And we have a lot of trades that end up being sort of the same trade on a correlation basis. And the issue with it, of course, is that those correlations change over time based on randomness, but also based on kind of what's going on in the market and where the risk is and what people are focusing on. And so obviously one has to pay attention to all of that. But we're paying attention to that anyway as we're looking for news failures for things we want to buy or sell, because we know the news is driving the market. So that's step A, right? Is that if I have a portfolio where the correlations are such that the risk is higher than one would think just by saying, oh, you're risking 75 basis points per trade, then I'm looking to hedge that portfolio. And there is either a opportunity to do so in a correlated market, let's say, or I can take the opposite side, or there's not. And if there's not, then what I will be doing is just reducing my overall positions. The best hedge is to reduce, right? But I like to not reduce because I like to have my positions on, because I find trading around my positions I'm very bad at doing, and I don't want to do that. I want to stick to my process. So if I can find a hedge, then I want to use it. So let's look at recently as the best example. I have primarily been using short 30-year bonds as a hedge to what I consider to be these positions I've had on recently, right? Because as I've been talking about a lot in my report, I feel that at this point in time, the bonds are everything. We've seen the largest inflows into the bond market this year in history, and they keep going down. I've done videos on this, okay? So we know this story, but if I'm going to be long something, I'm going to be long it versus how it's reacting to this bonds going down. So up until a few weeks ago, we kept seeing bonds going down, and that was pushing the dollar up because interest rates are going up, dollars going up, and commodities like gold are going down. And it was also hurting stocks because people started freaking out that these interest rates were starting to get to real kind of levels. So stocks are going down. So if I'm going to have a long stock trade, if I'm going to have a long commodity trade like long gold, if I'm going to have a short dollar trade, which I had all of in the last few weeks, the perfect hedge there to me, based on the correlation and based on the general psychology in the market, would be to be short bonds. So I'm not just shorting them outright every day, which is unfortunate, because if I was just net short the whole time, I would have been making money on both sides of that trade. But I'm specifically looking for times where my portfolio is reacting poorly to that. So if I'm long this risk, and bonds are going down and my portfolio is reacting poorly to that, that's when I need to hedge. So that's when I will try to sell bonds, right? And they usually tend to be short-term trades, because if my portfolio starts to act well, even if bonds are going down, but my portfolio, which is theoretically supposed to be correlated to that, is acting well despite it, then I don't need to hedge. My portfolio is doing fine, everything's, and I'll just take it off, right? So that's generally how I think about hedging. And it becomes a little bit of a moving target, what you want to use to do the hedging and all that, but that's just a function of paying attention, really paying attention to positioning, paying attention to the psychology, and paying attention to the movements and the correlation. It's not something you can just turn into a formula. There's a little bit of feel to it, unfortunately. So the next thing is, well, how do you size these trades, right? And because of shorter term trades, you're never going to get it perfect. Even if you know the perfect correlation between, let's say, bonds and these other things, doesn't mean it's going to be a perfect correlation every day, right? In fact, it's never going to be the perfect correlation every day, right? So there's a little bit of guesswork and a little bit of luck to that. There was one hedge that I did last week, or maybe it was 2 weeks ago, I don't remember, but where I got short the bonds against this stuff. And because there was a number coming out, I think it was PPI or something, and therefore if PPI was going to come out super strong, good chance bonds were going to go down, good chance it was going to hurt my other stuff. So I shorted bonds in front of the PPI and saw what happened. PPI came out strong, bonds went down for about a second, and then they went up, and I just got out. Right? My stuff ended up doing well, my portfolio ended up doing well, so I just got out of the bonds and I lost some. Then we had a CPI, same thing. I wanted to hedge it in front of it because the CPI came out strong, good chance my stuff would. And it was kind of working, right? I sized it and it was working. Bonds were going down, my stuff was going down more, but I was losing less money than I would have otherwise. And then all of a sudden we had this bond auction and it went horrible and bonds collapsed. And what I had on at that point overhedged my other stuff. I went from losing some money on overall to making some money overall because of the hedge. It was just luck, on the sizing thing. But in general, what I try to do in size is you start with dollar hedging, right? Here, I'm long, make up some number, $1 million of this risk overall. So to hedge it, I'll get short $1 million underlying value of the bond contract. That's the easy way to do it. Then what you're supposed to do is adjust that for volatility. So, and again, the problem with this is it's not steady every day. But in general, let's say I can figure out pretty quickly that for every move, 1% move down in bonds, my portfolio is going to lose, 1.5%. So therefore, I have to take the dollar value of what I'm shorting in bonds and add another 50% so that I can make up fully on the hedge. Like I say, not always going to work. Going to come pretty close. There's a little guesswork. There's a little luck, just like everything else. But it's a hedge, so it doesn't have to be perfect. But start with dollar value, try to estimate some volatility against it, and put that kind of size on. That's sort of how I do it. So I hope that makes sense. That's kind of how I decide what I'm going to hedge with. That's how I decide when and how I'm going to hedge, and that's kind of how I decide the positioning. I know there's nothing great here that's hey, this is exactly how, there's no formula, but it's just a general thought process of how I'm trying to do this. I just wanted to add one thing to this hedging idea. I have, as our subscribers know, I have been doing probably more hedging than usual over the last 2 to 3 months. And what I would like to believe is that I'm doing that because it's just the way the market is. We're not really seeing a lot of one-way movement. So hedging the portfolio is probably a great idea. We don't see a lot of great risk-reward opportunities up until recently. So I was trying to hedge because I wasn't, didn't have a lot of conviction. And I'm doing sort of normal portfolio hedging as well. I'd like to believe that's why I am doing that. I have been hedging a lot lately. But I have to keep in my mind, as we always try to do, subconscious reasons that I may not be in control of, and therefore I have to learn so that I don't let those take me over and get me off process. And I am aware of the fact that, look, I charge my clients a 0 management fee, and I get a higher incentive fee at the end of the year because of that. That's the choice that I made based on a lot of things. My costs are low. I don't have staff. I don't need a management fee. And I like to think it's because I have confidence in what I'm doing, so I will get paid more at the end should I do well. But I had a great first half of this year. I shoot for 12 to 15% returns for a full year. And I did pretty much that just in the first half of the year, just because we had some good trades and it was a good run. So it's very possible in the back of my mind, I'm thinking like, I don't want to blow that before the end of the year. So if I hedge stuff, then I might make less by the end of the year, but that's okay because I won't really lose and I will be able to get paid at the end of the year, what's coming to me, right? You have to believe that there must be some kind of motivation like that in there. I like to believe it's not. I like to think it's not. I like to think I just follow my process come hell or high water. And within that process, I do hedge and I speak to my clients about that and they are aware of that. So it's not like I'm totally out of process here, but in the back of my mind, I'm always trying to figure out what are my hidden motivations. So I think that might be one of them. I don't know, but just a thought as well to focus on sort of the psychology of all this, which we always want to try to be aware of. So I hope that answers your guys' questions about that. Of course, we're on the Discord all day, so you can always ask me more about it on there. Anybody who's not on our Discord, more than happy to hear questions and comments on this as well. We hope to see you on crowdedmarketreport.com. And I have been asked by my partner as well, if you liked our video, please hit the like button, because I guess that's how this YouTube things work. We're trying to get as many people to see these videos as we can. And I guess the more likes, somehow the algo sends it out to more people and they see it. So if you like it, please hit the like button. And other than that, as always, I hope everybody has a profitable week. It's going to be a crazy one. So good luck out there, and we'll talk again soon. Thanks a lot.
Subscribe to Crowded Market Report by Jason Shapiro.